As we get deeper into turmoil of this insanely slow Toronto real estate market, sales and months of inventory are now being compared with seasons of real estate going back to the last century. This October has been the lowest number of fall October sales since 1998, and of course, not due to low inventory. We're going back 25 years when Toronto had tens of thousands of fewer condos and townhouses built and significantly fewer housing units than it does today. For those of you that don't know me, my name is Jonathan Lee and I'm a Toronto-based real estate agent in Etobicoke. If you like Toronto and Etobicoke real estate content, click subscribe. I haven't been as frequent in posting content this past month, but I do plan on getting back on the horse and posting some more videos before the end of the year, so stay tuned. If you want to schedule a call to chat about Toronto real estate, you can click on the calendar link below in the description and we'll set up a time that's convenient for you. It's been a really busy month with the news headlines. The first I want to start off with is how slow the real estate market has been. Even though the Bank of Canada held interest rates flat just a couple of weeks back, consumer confidence has bottomed out and is at the same quantifiable level as it was at the start of the pandemic, the 08-09 financial crisis, and the deep 1982 recession. That would explain why GTA real estate is so slow. No one is spending money, no one is moving, which has resulted in some really interesting trends in the resale market. Firstly, there's been a steady increase in the number of new residential power of sale listings in the GTA. No surprise here, as homeowners default on mortgage payments, banks take over and attempt to sell the properties themselves to prevent further losses. Secondly, there's been an increase in vendor take-back mortgages being offered, which we haven't seen much of since the 90s. A vendor take-back mortgage is when the seller agrees to quote-unquote loan the buyer an amount of the sale at a lower interest rate for a period of time so the buyer can afford to purchase the property. There's not actually any money exchanged, but a seller is effectively agreeing to take less money on closing with the balance of the sale plus interest coming 2, 3, 4, or whatever years down the line when the buyer refinances. And 3, the last is a number of listings with quote-unquote motivated sellers advertised in the remarks of the listing. This is usually written in to encourage an offer even if it's a fair bit below the list price to get the property sold. I don't think this is a great strategy. If you're listing your property high but encouraging a lower offer, I think it's far more effective to just drop the price to that range. It removes the confusion out of the messaging and is much more likely to elicit an offer anyways. And that's just in the resale market. In the pre-construction market, we're hearing of huge development projects going bankrupt and heading into receivership, pre-construction buyers walking away from huge deposits because they can't close, leading to potential litigation issues. It is wild out there. Now, as I previously mentioned, the Bank of Canada ended up holding rates flat and mortgage prime rates are still hovering around 7.2%. In his press release, Tiff Macklem, the governor of the Bank of Canada, stated that we could see interest rate cuts before we reach our inflation target of 2%. This is pretty noteworthy because August GDP growth was 0%, meaning we're on track to hit a recession if we're not already in one. And history tells us a recession always leads to a slowdown in inflation, and on average, it takes 16 months or so for inflation to hit 2%. So if they're slashing rates before we've hit 2%, it's because our economy is in absolute shambles. Things are really bad and they're trying to stop it from getting catastrophic. So it's not something to cheer on, and it doesn't mean the worst is over. They're just trying to stop our economy from turning into a forest fire. But Tiff Macklem stating that we might see interest rate cuts earlier than the target is risking something that I've just learned about thanks to Daniel Foch, a real estate analyst, called the pivot paradox, which is when consumers behave as if they think rates are going to drop imminently and start spending again. We saw it earlier this spring in the real estate market when rates paused, which led to some people believing that rates could drop in fall of 2023. And depending on the tone the Bank of Canada takes over the next 6 months, we might see it again next spring. Ironically, this actually strengthens the economy and therefore inflation short term, but could also prolong the recession and this period of high rates. So if we back calculate 16 months or so from when rates started rising back in about May or June of 2022, that puts us in a recession maybe this upcoming December. The first quarter to announce negative growth might be Q4 of 2023, and with Q1 of 2024 being the second quarter. Could we expect rates to drop in fall of 2024? Maybe. Maybe not. And the reason I say maybe not is I could see this pivot paradox happening a couple of times over the next 1 to 2 years. I don't think we're going to see a steady slowdown, especially in the real estate market. I think it's going to come in waves, going up then down at least once more, which would draw out and prolong rates to stay high, which would not be good because The next few years will see $900 billion in mortgage renewals through chartered banks across Canada, leading to severe mortgage shock if interest rates stay high for long. 2024 will see $186 billion in renewals. 2025 will see $315 billion in renewals, and 2026 will see $400 billion in mortgage renewals. So we could be in for a 3-year prolonged period of market adjustments if things get really bad. Looking at just 2024, assuming a very modest 1/3 of all these $186 billion of mortgage renewals coming from the Greater Toronto Area, which I think is actually a pretty conservative ratio, that will put us at $62 billion in mortgage renewals. If we assume that these properties were purchased 5 years back in 2019, when average Toronto area home prices were $883,000, and most buyers paid a 20% down payment on a 25-year mortgage and would therefore have 20 years left, they will be renewing at an average amount of $583,000, which doesn't sound too crazy to manage, but this is really the best case scenario. If some of those buyers had opted to put less than 20% down, which was possible if their income was high enough to support the mortgage and they were purchasing under $1 million, or they had instead opted for a 30-year mortgage, or they had pulled from lines of credit during the pandemic and were planning on refinancing, they're paying more for sure. Now, assuming they were previously paying rates of around 2.75% on their mortgage, they were stress tested at 4.75% back then, they'll be renewing at around 6.5%, no which way around it. They're absolutely paying a higher monthly mortgage, even if they attempt to refinance their home to reset their existing balance to be paid across 30 years rather than 20 years, the monthly mortgage is still going to be hundreds of dollars higher than what they were previously paying. So let's take a step back to that $62 billion in mortgage renewals in the GTA. Assuming the average renewal will be $583,000, that equates to 106,346 properties in the GTA that will be renewing. If just 10% of those homes can't afford their mortgage renewals and must sell because they're over leveraged, because they're experiencing a loss of income or stagnant wages, that would equate to an extra 10,600 properties coming onto the market in the GTA in just 2024. The last rolling 12 months from November 2022 to October 2023 has seen only 66,000 in the GTA with 136,000 listings, not properties. Many homes get listed multiple times. Adding an extra 10,600 new properties that must sell during a time when it's hard to qualify for a mortgage and when you're competing with all these other motivated sellers will absolutely have an impact on the market and home prices. We're already seeing a market that has supply that exceeds demand. So I'm expecting most of these distressed sales that come down the line will be condos, as condos has the highest rate of investment and investors will most likely be the highest leveraged homeowners. So we'll see condo prices take the biggest beating, but this will absolutely have an eventual trickle down effect on freehold homes as well. Upsizers won't be able to sell their condos for as much money, which will affect their ability to pay high asking prices for freehold homes, resulting in sales just not happening or more downward pressure on freehold houses. This will likely be 90 days out or so from when condo listings peak, but while freehold and condos are separate markets, they aren't completely independent from each other. They are somewhat intertwined as well. So the next 6 months to 1 year of real estate probably won't be rosy. The bull run up of home prices over the last 15 years might be behind us, and there's a chance we might see some fundamental changes to the Toronto real estate market coming up. One of which might be the end of the casual short-term real estate investor. In the last 5 years, everyone became or wanted to become a real estate investor, with a ton of TikToks talking about how you could buy, renovate, refinance your homes and build your real estate empire and retire when you're 18. And it seemed like there was a belief that with real estate you just couldn't lose, even short term, because the last 10-15 years conditioned everyone that that was definitely the case. Holding long enough, 20 years plus, you're extremely unlikely to lose, but most investors weren't looking over a long enough time horizon. And I think over the next couple of years, we'll probably see a lot of investment losses in real estate that will spook a lot of the casual investors out of trying this again, at least for the next while. But I also firmly don't believe home prices will see much more than like a 10% drop long term. Your minimum $1 million houses will retain its value for a number of reasons. One, home construction costs are too expensive for homes to make a huge drop because of our high cost of labor, which is driven by our overall low population, our high cost of living, and our highly educated population. We can't afford to build cheaper unless we bring in cheaper skilled laborers from abroad, which is unlikely to happen. Two, housing is not being built fast enough in the GTA and land remains at a high premium. 3, we're still very much growing as a population. And 4, development charges, which gets passed on to the buyers, are still incredibly high. So that's it for me this month. Once again, I'm Jonathan Lee, a Toronto area real estate agent. And if you would like to schedule a chat, you can click on the calendar link below. Thanks for watching, and I'll see you guys in the next video. Cheers.